Well, if I was taking a course on stock investing, probably the first question I would have is, hey, can I make money in stocks? And if so, how much? That would be pretty important to me, and I'm sure it is to you. And the good news is, yes, you can make money in stocks. In fact, stocks outperform things like bonds and cash and other asset categories, so they're a great way to grow your money. I suppose this is a pretty short and lousy class where you said, well, no, you can't. Since it's a good long course, yes, the good news is that you can. The key is historically you can make stocks. That doesn't necessarily mean you can in the future, or the past predicts the future, but we have over 100 years of information. So yeah, stocks can make money in the future here, I believe. Certainly over the long term, stocks make money. In the short term, they can be really risky or volatile, go up and down quickly, but over the long term, they do make money. And I'll show you some charts and things in a second here, and that shows that. And they do tend to go up once again over the long term. Individual stocks might go down and never recover, certainly, but if you have a diversified portfolio of stocks and apply some of the principles you're going to learn in the course here, you're going to be in a much better place than somebody who's just buying stocks without really much education. So historically they go up, there's a long-term investment, and they tend to go up over that long term. So how much? Let's take a look at some charts and some numbers so you get a feel for how the stock market kind of works as far as returns. This chart here just shows some historic market returns. Looking at the Dow Jones, it's a smaller basket of stocks. Only 30 of the largest U.S. company stocks that are representative of a variety of industries. Been around since 1896, and I wanted to use this, though it's not truly representative, it really does follow the rest of the larger type of stock market generally. And as you can see over this chart, if you start over in the 1900s, stocks go up, and over the long term, as we get into today, you can see that stocks have gone up by following the upward motion of that chart the whole time. That's the good news. Now the challenging news. You can see there's some drop-offs in there, as it's not just a straight line going up. There are up and downs, peaks and valleys, and when it's going down, that means your investments, your stock has gone down. Maybe that's a great time to buy some new stocks, actually, as you're buying low with the idea of eventually selling high, right? Stock investing 101. If you look at here, look at the end of 1929 here, right at the beginning of 1930, what happened then? All of a sudden stocks went plummeting. Well, that was the Great Depression, right? That was the Great Depression of the 30s, and you can see how the Great Depression stocks went down pretty quickly, very quickly. But they rebounded, and they overcame the Great Depression. They overcame World War II in the 40s, and they overcame all these things that are these obstacles to stocks and the world and challenges overall, and have continued to rise over a long period of time, outperforming things like bonds and cash and their peers. So long-term investment, it can be really, really good as far as investing in stocks. If we wanted to see how much return that would be, looking at this chart here, I pulled this out of Vanguard. Vanguard has some sample portfolio, so they did a more broader based look at stocks from a larger amount of stocks than just the Dow Jones, so they can give you a feel for average annual return over a long period of time. This is looking from 1926, right before the beginning of the Great Depression, happening in October 1929, all the way up to at least 2015. Not too far in the rear view mirror here for us. And this is a portfolio of 100% stocks, broad base of stocks. And you can see the average annual return is 10.1%. So somebody says, oh, the average return in stocks is 10%. That's kind of where they're getting that number from. It's not totally the total story on that, but it's at least a starting point number to say, yeah, it's not like 1 or 2%, or it's not keeping up with inflation. It well is. So you're looking at 10%, but that could be, it's been less in recent years, maybe more in other years. And you can see the range, the best year and the worst year. Best year overall stocks up 54%. Wow, hooray. Worst year down 43%. Oh my God, that's not fun at all, right? So you can see that broad range. And the interesting thing with that broad range, that's right in the middle of the 30s, right? You got the Great Depression, and stocks went way down, and then they went way back up, and they went down, and all that. You can see that was a very volatile time, and we got some volatility now, but not like that. Years with a loss. So this is saying that out of 90 years of investing in stocks over this 1926 to 2015 time period, 25 of those years you're going to have a loss. It might be only 1 or 2%. It might be as big as 40%. But 25 of the 90 times you're going to have a loss. The good news is the other times, the other 65 times, you've got a gain, or at least breaking even. You've got a gain, you don't have a loss. And so that's some good news as far as investing in stocks. If we looked at it by another chart here, just to give you a feel for it and get you comfortable with it, if we looked at stock market historical returns by decade, you can kind of see where they're at as far as that too. And you can see some of these early numbers here. They got the 10s, 1910s, 1920s, 1930s, all that. Even the 30s with the Great Depression, you can see at the end, if you start at the beginning and then at the end, you lost like 0.63. Yeah, it was 10 years of misery, but it wasn't like you were down 40% for a whole decade. And if you kept investing, you were buying low actually during that period. Then most recent times, you can see we have the 1980s and certainly the 1990s with the internet boom and bust. So you had that. You had the 2000s where it was pretty flat. That was kind of considered, kind of a flat time period. This is once again looking at overall stocks, more U.S.-based stocks for this number. So overall, but worldwide it will fall a little bit too. But just to give you a feel. And then more recent times, some better returns, but that can be up and down too as well. It's very, very recent type numbers. So the thing to take from this is that, yeah, there's going to be up times and there's going to be down times, but overall there's some up times. And particularly if you continue to invest and continue to take a portion of your income and invest it regularly in the stock market, you're going to do very, very well. In a broad diversification thing, I certainly advocate investing in things like bonds and a little bit in cash possibly, depends on your investing goals and all that, but you can see some returns here. Let's finish this lesson here with one other thing. We're going to do a demonstration here, and we're going to look at one other thing here as far as, well, what if I continually to invest in stocks, and how does my money grow over time? I mean, I'm taking on some risk. Yeah, the returns look pretty good. What will it look like in the future for me? So let's do a demonstration of that. And really where you go is you go to MoneyChimp, you go to moneychimp.com, go to Compound Interest Calculator, and you will find it. So let's go take a look at that and do some demonstrations. Okay, we're here in moneychimp.com. I think that's kind of a fun name, right? Moneychimp.com, you can see in the upper right. We're in the Compound Interest Calculator. If you just go into their calculators or calculator / compound interest, you'll find it. It's a very simple calculator to show how your money grows over time. And we'll do a demonstration here with this, and you can go to this and play with it yourself and put in your own numbers based on maybe how much you have to invest in a particular time and how much returns and things you might expect. So let's say we start with 0, or we're going to walk through this different calculator, and it's going to tell us at the end, what is our future value? What are we going to end up with after a certain time period? So let's walk through this real quick here. So let's say my current principal or money that I have right now is 0. I don't have anything invested at all. I have 0. And let's say that every year, annual addition, let's pick a number here. I'll use US dollars. I'm from US, so bear with me. You could use rupees. You could use pounds, you could use euros, whatever your currency might be, but let's say we'll use dollars in this case. And let's say every year, let's say I'm doing well and I contribute $10,000 a year. Maybe it's less than that. Let's say I'm just doing half, let's do a little less. Let's say $6,000 a year savings and investing in the stock market, all right? Once again, you adjust it a little higher, a little lower, whatever you want to do. And let's say we do this over 30 years, right? So if I start at 25, let's say that would put me at 55 years old, not even 40 years. That might get me closer to a traditional retirement age. And as we saw in stocks that we could get, around a 10% return on a rate, maybe a little bit lower. Certainly we don't know what the near-term future is, so let's go real low. Let's say, we could get 7% on our stocks. We're not going to say 10 or 9. Let's be pretty conservative on it. And if we have an overall diversified portfolio of stocks and bonds and cash, we might even put a little bit lower number on that. But let's start with 7 just to see what it is. Make additions at the end of each period. So that means at the end of every year, you'd add $6,000. You could be investing every month too as well. That's actually a better strategy. But for the purposes of the calculation, here's our numbers. We start with nothing. We're investing $6,000 a year over 30 years, 7% annual return. Let's see what our number ends up at the end by investing if we can get a 7% return on our stock market portfolio. And you can see we're at $566,000. So, just by investing that every year and how it grows and compounds, we're over $500,000. If we let that grow to maybe a more full retirement age, let's say 40 years, and as we got promoted and did things at work or in our careers and we were able to put away a little bit more, maybe we were able to do $9,000, still 7% interest, how would we do then? Wow, that's like $1.7 million. That's pretty good over a 40-year period. So you can see how stocks and things grow. Let's go back down to our 6,000 just over a longer period. And you can see even with 6,000 a year over a long period, 40 years, it'll grow and you're over almost $1.2 million. And if you're closer to your retirement age or you're closer to things, just adjust these numbers down. Maybe you need to put in a little bit more and take out less years to grow. The point of all this is that by investing in an asset class like stocks, which will be riskier but outgrow the market, you can see you can get some pretty good returns here over time, and that's what helps fund your future goals and your future dreams. So can you make money in the stock market? Yes. Now, is it risky? Yeah, and that's what we're going to talk about in the next lesson here, and we're going to look at the worst case scenario, and I think that'd be pretty interesting. Well, what's the worst that could happen? And that's coming up next.